Hey everybody, it's John King with Summit Funding. It is my Financial Friday live, and for the first time ever, I am a minute late. Super sorry, had some technical difficulties today and could not get the system set up on time, but we are now live, ready to roll, and I appreciate your patience, so forgive me for being that minute late. Anyway, today we are continuing our series, Financial Fridays, talking about financial topics. They might be mortgage-related topics, they might not be mortgage-related topics, but my goal is to give you really information about how to lead your financial life and guide you with decisions that you're making. And today we're going to talk about, is it a good idea to refinance? That is a topic that I get asked all the time, especially in today's market where interest rates are up. And people are saying, John, obviously it's not a good idea to refinance because I've got a higher interest rate today on the market than what I'm offering, what you're able to give me. And so clearly I shouldn't refinance. The first thing I want to tell you is that refinancing is not as easy as just saying, is the interest rate lower? And I'm going to talk to you about a lot of different pieces to this and what you need to know in order to decide if refinancing is a good idea. So the first thing I want to say is, first and foremost, is refinancing a good idea is a specific calculation that I will make with you, but I want to encourage you not to simply say, well, gosh, John, interest rates are up, I should not refinance. That having been said, I don't want you to refinance unless it makes sense. So if your interest rate right now is lower than market rates, unless you're in a position where you have other debts that might be of higher interest rates that we can consolidate, unless you're in a position of needing money to do something, maybe some work on the home. It's funny, I find people wait to do work on their home until they're at the point that they're selling their home. And they make their home perfect. They make it exactly the perfect home that they want at the time when they're trying to sell it. And they never lived in the home that was the way that they wanted it. They simply waited and dealt with it. So if you're in a position where you say, hey, we've gained a lot of equity in our home, and you have, it might be a good time to pull some of that equity out of the home instead of waiting until you're ready to sell the house. There are other circumstances that I'll talk about that might make it a good idea to do a refinance, but don't misunderstand. If you have a low interest rate, even if you want to shorten your term, you probably should not refinance to shorten the term. To give you a quick hint, you just pay a little extra. Okay, you don't have to pay fees to refinance. You're not getting a lower interest rate. If you want to pay off faster and you have a lower rate than market rates, just pay a little bit extra every single month. I can show you the calculation. I talk people out of refinancing every single day. So my goal today is not to talk you into it. My goal today is to educate you on the things you need to think about and to dispel some myths on when you should or shouldn't refinance. So the first myth is I should refinance whenever rates are lower. That just isn't true. There are times, and I'm going to show you a couple of examples of where if you have a lower rate, if you can get a lower rate, it still isn't a good idea to refinance. So get it out of your mind. Interest rate is never the reason to refinance. It's a part of the equation. It's one component of the things that I'm going to look at to advise you, but it is not the reason that you should refinance. So what are the reasons why you should refi? There are actually three reasons, and three reasons only, that you should refinance. So the first reason is to lower your monthly payments. Now that might be the monthly payment on your current mortgage. Maybe you're in a position where you were a little too aggressive. And I had a lot of clients actually that have talked to me recently about this, where they maybe talked to another lender because somebody picked up the phone and called them a year or two ago. Interest rates were way down. And they said, hey, we can get you into a 15-year loan. And all it's going to do is raise your payment by $500 a month. But look at how much money you're going to save over the life of your loan. That was very true. It still is very true. The problem is if you can't afford the monthly payments, you're going to lose the house. So you might be in a position where your income has changed. A family member has lost a job. Expenses have gone up. And you're literally in a position where, John, I can't afford the monthly payments that I'm making today. I'm handcuffed and I can't afford a birth of another child, an unexpected family member that comes to live with you, any number of additional expenses that say, hey, my aggressive plan to pay off my mortgage faster, it just can't happen anymore. And I need to lower my payments. Now that ideally is happening when we can get you a lower interest rate, but the truth is no matter what the new rate is, if you cannot make your current monthly payments, you're going to lose your home. So you need to think about refinancing to lower the payment if circumstances have changed without regard to what your interest rate is. The other thing, though, that we can do is we can consolidate debts. So we can put your debts together into one loan and lower your overall monthly payments. And I'll talk to you about how that works in a couple of minutes. So that was reason number one for refinancing. Reason number two for refinancing is to shorten your term. Now, I said a couple minutes ago, don't refinance simply to pay off the house faster. You can just pay extra to pay off the house faster. But if interest rates are lower, or we can lower your blended rate, we'll talk to you in a few minutes about what blended rate is, then you can be in a position where you can pay the same payment you're paying today, but because you've got a lower interest rate or a lower blended rate, less of that payment goes towards interest, more of it goes towards principal, and therefore you pay off the home faster without spending anything extra per month. So if I could get you to pay off your home faster without adding an extra penny to your monthly payment, that absolutely is a worthwhile reason to refinance. Again, in today's market with interest rates being higher than what most people have, it's not often we're going to find that to be the case, but you'd be surprised sometimes where taking a higher mortgage rate than your current mortgage still might make financial sense for you. And then the third reason to do a refinance is to pull cash out. Now, why do we pull cash out? Any number of reasons. The first thing I want to caution you is please, please, please do not treat your home like an ATM machine, because that ATM is going to run out of money sooner or later. We have seen a significant increase in housing prices over the last 2 years to the tune of like 35%. Now, if you're in a position where you bought your house 3 or 4 years ago, you have a huge amount of equity now that you didn't have. And you might be in a position where, hey, I've got work that I wanted to do on my home that I've been dying to do, but I couldn't because of the circumstances of not having enough equity to pull out of the home. Or you did the work, but you paid for it on credit cards. And now you owe $30,000 or $40,000 in credit cards. And by the way, the Federal Reserve raising the prime rate right now is directly impacting your credit card rates and directly impacting your credit card payments. And so what you have to worry about is that credit card debt is now going to be skyrocketing even more, and that you may be better off consolidating that and pulling cash out to pay off that debt. So cash out's used for lots of things. It's used for paying off a co-owner or ex-spouse. It is used for just future needs. Maybe you've got college education you need to be thinking about. Maybe you've got work that you want to be doing on the home, or debts you want to pay off. Lots of reasons to pull cash out. Sometimes that cash out can come without increasing your monthly payments. Sometimes you don't have an option but to increase your monthly payment. And then it becomes, what is your best alternative? Because when you're pulling cash out, you have options between, hey, do I want to do a full refinance, or do I want to do a home equity loan or line of credit? And I'll talk about that in a couple of minutes. So let's talk specifically about why lowering your interest rate is not a reason to refinance. I'm going to give you a couple of examples here. So let's dive into an example of why lowering your interest rate is not a reason to refinance. What you're looking at right now is you're looking at someone who took out a 15-year loan in the past, and they were called by a lender and saying, hey, I can refinance you. So this guy's current interest rate is 3.5%. Let's make this a little bit bigger so we can see it full screen. So the current interest rate is 3.5%, and it's a 15-year loan. And somebody calls and says, hey, I can give you a 2.5% 10-year loan. On the surface, that sounds amazing. As a matter of fact, if we dig a little bit deeper, here we go. All right. So we're going to see you're at 3.5%, and you're going down to 2.5%. Your payment is currently $2,300, and they're saying, hey, we're going to lower your payment to $1,400, saving you $862 a month. Everybody's going to say, oh my gosh, where can I sign up? I'm saving 5 years. I am saving $862 a month. This is too good to be true. Well, it is too good to be true, because here's the deal. The first scenario, your current loan, what you weren't thinking about and what they didn't tell you is you took out that loan 9 years ago. You have 5.9 years left on that loan. But they didn't remind you of the fact that you had 5 years left. They reminded you that you have a 15-year mortgage and you're paying it off in 10 now, but they're extending your term by an extra 4 years. Little deceptive practice that a lot of lenders unfortunately don't disclose as they're talking to you. And so you're actually increasing your term. Now, somebody might say, well, okay, that's fine. Then I'll just keep making the payment I'm making today. But because the interest rate is lower, Mr. Smith, I can give you a new loan at a lower interest rate than what you're paying today and just keep paying your monthly payment that you're making, because that will allow for more of your payment to go towards principal and less to go towards interest. And that's true, except they weren't accounting for the loan fees. So in this case, you're actually paying off in exactly the same amount of time. As a matter of fact, about a month more, a month longer, because you have fees that are added to the loan. So when you lower your interest rates, you have to also account for what the fees are. And am I going to save enough money over time to pay for those fees? It's critical for people to understand that fact, and that you're not just simply, hey, I want to save money off of my interest rate, and so it's a good idea because my rate is lower. That's a great example, a great illustration to show you, I need you to stop thinking about lowering your rates. That is a tool that we use to accomplish one of the other three goals of shortening your term, lowering your monthly payment, or pulling cash out. And sometimes we can do all three, depending upon the nature of your finances. But it's never a one size fits all, and never let anybody tell you, oh my gosh, you should refinance because your rate is lower. There's lots of little ways that they can deceive you going through that. All right, so now let's go to, there we go. Now let's go to, I was told to never refinance since I'll never pay off my mortgage. First of all, that's a true statement. If every 5 years you refinance to a new 30 years, you'll never pay off your mortgage. That's a fact. Unless you pay extra, but let's set that aside for a second. By the way, guys, if you're watching live, feel free to post into comments any questions you have about refinancing. I'm going to have time for comments and questions throughout this presentation. So if you have questions about anything I've said or anything that that you want to make sure I cover, please cover it or post it in comments. If you're watching recorded, same thing. Post it in comments and I'll go back and I'll catch the comments and I will respond to you directly in comments. So let's make sure that we're being interactive and make sure I've got about 8 people on here right now and on different platforms. And let's make sure that you are sharing with me what you're looking for to get out of this presentation that we're doing today. But the bottom line is you should be cautious about continuing to refinance your home over and over again. But here's the other fact. The fact is, very rarely does somebody keep their home for 30 years. So even if you took out your 30-year mortgage, and even if you had the expectation, hey, I'm never going to refinance because my friend refinanced and they never paid off their mortgage. The truth is, what are the chances you're actually going to have this loan in 30 years and have this home in 30 years to have paid it off? And are there better decisions you can make with your money now to help you build a better financial position and build more wealth over the lifetime of you owning this home? The timeline of somebody on average owning a home right now is approximately 5 to 7 years. Now it's going to be a little bit longer, meaning it's been closer to 4 or 5 years historically. Right now, we're probably in 5 to 7 years because people have such low interest rates and the economy is super volatile right now that they are concerned that or let me say this, you're going to stay longer. You're going to stay in your current home because you don't want to give up your current mortgage. You don't want to give up the current interest rate that you've got. I understand that. And so you're not going to move as often as you did before. But the truth is you're still not staying here for 30 years. So the fact that you were told to never refinance because you'll never pay off your mortgage is too blanket of a statement. But I certainly agree with the theory. Don't habitually refinance without a good benefit, because otherwise you're going to continue to dig a deeper hole by extending your loan out for 30 years. But remember, you don't always have to extend your loan out for 30 years. As a matter of fact, we can do a loan that matches the current term you have right now. So if you have 27 and a half years left, you can take out a new mortgage with a 27 and a half year term. That's something most people don't understand. So it is not necessary to stretch it back out to a 30-year loan every time that you do a refinance. What does it cost to do a refinance? The truth is it costs almost exactly the same as it costs you to do the loan when you purchased your home. The bank, the lender, my company is doing the same amount of work. We've got to do an appraisal on the property. The title company has to do research to make sure there's no other liens on the property. We've got to pay for underwriting and processing fees. All of the costs associated with doing a loan are the same, whether you're purchasing or refinancing. And as a matter of fact, in some cases, it's a little bit more expensive to refinance because of the risk that comes along with pulling cash out of your home. Fannie Mae sets the risk on how we charge fees for loans based upon what your credit score is, how much equity you have in the home, and a bunch of other things, one of which is, are you pulling cash out or not? Because the expectation is those that pull cash out once are likely to do it again. They might be in financial challenges, and the worry is there's a little bit higher risk of default on that loan because it was used for cash out. The other thing I want you to pay attention to is something called recourse versus non-recourse. When you, I'm not sure if this is a federal theory or a state of California theory or law or whatever you want to call it, but the fact is when you purchase a home, that debt, at least in the state of California, I'm not an attorney, don't play one on TV, so take everything I'm about to say as just a theory, not fact. But when you purchase that home, the debt you use to buy the home is called non-recourse debts. What that means is that if you default, if prices drop, you can't make your mortgage payment. If worst case scenario, the meltdown we had in 2008 happens again. By the way, I do not have any expectation that meltdown is going to happen again. If you have not refinanced your loan, they can only come after the home. Once you pull cash out of your home and do a refinance, it is now considered recourse, which means that they could theoretically come after you. Now, we saw in 2008, they didn't do that very often, but they can. And if you pulled cash out of your home to go buy a whole bunch of toys and an RV and jet skis, they're going to come after those toys. So you've got to be aware of the fact that when you pull cash out, you are losing the benefit of a non-recourse debt. If you have more questions about that, talk to your attorney, because that's a complex issue that I don't want to be giving legal advice on. But the fact is that you're paying fees when you refinance, and it's something to be super important, super aware of when you're deciding, hey, is this a good idea or not? All right, the next thing I want to talk about is how do I actually go about lowering my payment? There's a couple of things that happen here. First of all, remember the three reasons to refinance: lower your monthly payment, shorten your term, or pull cash out. We're lowering your monthly payment sometimes by stretching you back out to 30 years. If interest rates are lower than your current mortgage, then maybe we can keep you at the exact same timeline of your loan, have you still paying off in 26 years, but because rates are lower, we can charge you a lower interest rate, and therefore it lowers your monthly payment. But the truth, like I said earlier, is you're not likely to have your home in 30 years. And so if you have 26 years left or 30 years left, it isn't that big of a difference. Most people, if they want to lower their payment because they're in a financial bind, are going to stretch back out to 30 years. It's all about the thinking of short and long term, and I'll talk in a couple of minutes about short term versus long term. So let's talk about an industry term called a rate and term refinance. What a rate and term refinance means is that you are refinancing, you're doing a loan, let's be clear, you're doing a loan that is not to purchase a home, and it is not pulling cash out. So it's kind of the middle ground that says, okay, so it's a refinance, but it's not cash out. So you must be doing that to lower your interest rate and or your term. It's a bit misleading because I said earlier, it's not about lowering your interest rate. It really should be called a payment term refi, which is, hey, you're doing it to lower your monthly payments or shorten your term or both. But it is called a rate and term refinance. So if you hear that term, they're basically saying it's not a purchase loan and it's not a cash out refinance. So it's that middle ground called a rate and term refinance. So let's go over an example of how a rate and term refinance would work. So this example, you are currently 5 years into your 30-year loan. So you have 25 years left. And you say, okay, John, rates have dropped. I'm currently at 4.5%. So let's pretend that you got a loan sometime in the last couple of months, and 5 years from now, rates drop back down to 2.99. This is what you would do. You would call me up, I would call you up, and we'd say, hey, we can save you 1.5% off of your interest rate and get you down to a 2.99% rate. That takes your payment from $1,773 a month down to $1,389. By the way, I want to be super clear. All the payments I'm talking about today don't include taxes and insurance because that part will skew the savings. But the truth is, whatever your payment is, the payment after is still going to be the same amount of monthly payment savings. So we're going to save you $383 a month by going to a new 30-year term. If you need the biggest payment savings, that's the way you do a rate and term refinance to give you the biggest payment savings. But I'm not going to stop there. Most lenders do. What I'm going to do is I'm going to put together this analysis like what you're seeing. It's going to say, hold on a second, you have 5 years left on your loan. Why don't we talk about doing a 25-year loan? I can drop you from 4.5 to 2.99, but not add time to your loan. Now you're still paying off in the same 25 years. So you don't have to worry about that theory of don't refinance, you'll never pay off your mortgage. And you still save $210 a month. But it gets better. If you want to go to a 20-year loan, I can do a 20-year loan paying off your home 5 years faster for almost the same monthly payment as you're paying today, about $36 a month higher. Now, I want to stop for a second and give you an advanced strategy. I actually recommend for a lot of people who have the financial discipline to write a bigger check than what is required to take out the 30-year mortgage. So they take out the loan where the required payment is only $1,389, but then write a check every month for the $1,800 a month, the $1,809. The reason why that's important is because now you have the flexibility to fall back to the $1,389 a month if some financial calamity comes up. Think about, I have a client right now who did a refinance down to a 20-year back in 2020. I explained this option to them and I said, hey, I think you're better off going with the 30 and paying extra. And they said, John, I'm not disciplined enough to write a check for more than what my payment coupon says. I'm not going to pay the extra. I completely agreed. And I said, great, let's go with the 20-year term. Unfortunately, they called me back last month and they said, I've got a problem. My spouse's job cut back their hours. And I'm in a position right now where I can't afford that 20-year payment given inflation, how high prices have gone up on everything. I'm in a position where this is being a struggle for me. And I didn't say I told you so because that wouldn't feel any better. I'm not saying I told you so. But the reality is, had they had the financial discipline to just take the 30-year and pay extra, they wouldn't have needed to refinance right now. Now we're refinancing because we're also paying off some cars and some credit cards. And maybe we would have refinanced at this point because of the spouse getting their hours cut, inflation, everything costing more. We might have refinanced anyway, but we didn't have to because we would have been able to fall back to the 30-year and save that extra amount without incurring the cost of refinancing. All right, so let's go back and look at the numbers and let's see what it looks like if we did a 15-year loan. This is the final option that I would show you, is to say, hey, how comfortable are you with your monthly payment? I get this a lot from people. I don't want to refinance because I'm okay with my monthly payment. As a matter of fact, I'm paying a little bit extra. Well, I can compare how much extra you're paying right now at the 4.5 compared to paying that extra if we lowered your interest rate and put you on a 15-year term. In this case, the 15-year loan has a much lower interest rate than the 20, 25, or 30. And if you didn't catch that, the 30-year and the 25-year pretty typically are the same rate. The 20-year usually is a little bit cheaper, but not a lot. The 15-year is typically where you save the most. And there's some reasons why that I can explain, but the bottom line is that the 30 and the 15 are the most common. And what's a weird fact is people who do 20-year loans actually default more often than people who do 15-year loans. Now, John, how can that be? How can an average, if we took 100 people that did a 15-year loan and 100 people that did a 20-year loan, you're telling me that more of those people that are on 20-year loans would default than the ones on 15? The answer is yes. Here's why. Because the 20-year loan represents somebody that is stretching their budget to try and pay off their home faster, but they can't afford to stretch it all the way to a 15. Think about that. The 15-year is the gold standard of a shorter term loan. And so lots of people do them regularly. If you could afford the 15-year, you'd do the 15-year because the rates are better. But the fact that you're not doing the 15-year tells the industry you're stretching to get there. You're barely making it to get to that 20-year payment, and therefore you're more likely to default. That's why the 20 years only a smidge lower in interest rate than the 20 years only a smidge lower interest rate than the 25 and the 30, and the 15-year is the gold standard that gives you a significantly lower interest rate. So let's go back and finish looking at the numbers here. On the 15-year loan, you're paying an extra $388 a month, but it's paying you off significantly faster. So let's look at what this means if we project out 5 years after you complete this refinance. On your current loan, if you didn't refinance, you would have spent $68,000 in interest in the next 5 years. Your new loan, you would have spent a whole lot less. Even on the new 30-year, you only would have spent $54,000 plus $7,000 in, actually, excuse me, $47,000 in interest plus $7,000 in fees for a total of $54,000. Even on the 30-year loan where you're stretching it out, even though you added $7,000 in fees, you are still saving $15,000. And if you go over to the 30-year loan, you're saving yourself, if you go to the 15-year loan, you're saving $30,000 even after paying for the fees in the first 5 years. Now let's project out 15 years. You've saved significantly more. If you can afford that extra $383, your 15-year loan saves you $108,000 in interest compared with the loan fees and the interest you're going to pay on the 15-year loan. It is significantly better going that direction. So you have a lot of savings when we do that. All right, so let's go ahead now. I believe that's my last. No, okay. So basically, I was just pointing out you saved $108,000 by going that direction. All right, so I've got a question from Kathy. Let's go ahead and pull up that question from Kathy. Kathy said, so I can choose to pay $50 to $100 a month and pay my loan off earlier. Do I have to tell the mortgage company or can I just do it? That is a phenomenal question, Kathy. So there is a hierarchy of how your extra payments are applied, and it's federally mandated. So if you have back due payments, past due payments, they have to apply it to the past due payments. If you're behind on your escrow balance, they have to apply it to your escrow balance. But as long as you're caught up on everything, every dollar you pay over and above your normal payment is automatically applied towards principal. So you can just write a bigger check, and every single month that will pay down the principal faster. Your payment won't get lower, but next month, because you owe less than was scheduled, less of your payment goes towards interest, more goes towards principal, and you end up owning the home faster. So yes, you can always pay extra, and it does not create a problem for you by going that direction. So let's now talk about what matters more, long-term savings or short-term savings. I've kind of alluded to this a little bit, but I want to put a really fine point on it. We think about, oh man, if I can get the lowest interest rate and pay off in 15 years, I'm going to save $108,000, John. You just showed me the numbers. But the problem is, if you can't afford that payment, your house is going to go into foreclosure. Short-term savings, short-term financial stability is more important than long-term. Let me say that again. Short-term financial stability is more important than long-term. As long as you achieve short-term stability, long-term is super, super important. But you cannot be in a position where you do not have short-term financial stability just because you have a better long-term position. Remember, your house will be foreclosed upon if you don't make your monthly payment. If you could afford it, wouldn't a 5-year mortgage be better than a 15-year? But you can't afford the monthly payment. So the theory of, hey, I need to make sure I'm saving the most amount of money long-term isn't where you need to start. And this applies to cash out. A lot of people say, John, I don't want to pull cash out to put my car or my credit cards into my mortgage as part of my mortgage. You're right. Long-term, you don't want to take a car loan and stretch out a 7-year car loan into a 30-year debt. As a general theory, that's a horrible idea. But the fact is that if you can't afford to pay your mortgage, your credit cards, and your car loan right now, then who cares whether it takes you 7 years or 30 years to pay off the car? The fact is you can at least keep your home. That's what I'm talking about when I'm talking about short-term versus long-term savings. All right, so let's go back now to, should I always go for the shortest term? This is, again, a little bit of a calculation that I want you to think about. First of all, and I alluded to this a little bit earlier, but I want to be really clear to make sure I cover it. If you take a longer term and you pay extra to equal the shorter term payment, you take a 30-year loan and pay extra to equal the 20-year payment, it gives you flexibility to fall back on that monthly payment that you have for the 30-year. Let me say that again more clearly. My best advice for someone who's trying to pay off their home faster is to take out the longest term loan possible and pay extra every single month to pay it off faster, but it gives you the ultimate flexibility that if something goes wrong, you have the ability to fall back on that lower monthly payment. So do not always simply go for the shortest term. Sometimes it's a good idea, but if you have the financial discipline to set aside the money and pay extra or invest that money into something else, and I'll cover that in a moment, you are way better off than handcuffing yourself to that higher monthly payment of a short-term loan. So short-term mortgages are great in theory, but financially not always the best choice. All right, so let's talk about cash out refi. Oh, excuse me, I had one more thing I want to talk about on short-term mortgages. There was another, let's pull that up here really quick. So the other thing about short-term, let me go back, I got the wrong slide in here, is invest the difference. So go with a longer term. That was the other piece I want to talk about. You can go with a longer term loan and save the difference in the monthly payment and invest it in the stock market. Now you're going to say, oh my God, John, the stock market, we've lost 20% in the stock market just this year. We sure have, but I'll talk in a couple of minutes about how that isn't really that big of a deal in the long term. But guess what? Now you're setting aside money that you'll never need to pull cash out again because you're building a nest egg. By taking that monthly payment savings, you're building a nest egg. That'll give you money you can pull out for if you need to do debt consolidation, if you have a college education you need to fund later. It is giving you a lot of options that you can build up that nest egg and then take that nest egg and pay off your mortgage when it's time to retire. I'll show you how that works as we move forward, but let's switch over to cash out refinance. So we've talked about how to lower your monthly payment. We've talked about examples of rate and term refinancing. Now let's talk about cash out. So a cash out refinance is you pulling money out of your home, even if you owe nothing. If you have a house that you own free and clear, it's still a refinance. People will say, John, I don't have financing, therefore how can you call it a refinance? Because it's not a purchase. And in my industry, you're either buying or you're refinancing. So you can refinance to pull cash out of a property, and you can use it for anything that you want. There is no restriction. There is no requirement for it to be used for certain things. You don't have to invest it into the home that you're pulling cash out of. It also doesn't help you to invest it into the home you're pulling cash out of, meaning it doesn't give you any extra savings. There's a myth that, hey, if I use the money to remodel the house that I live in, then it is a less risky loan. It's not. As a matter of fact, there is a loan program called a renovation loan where you can pull money out in order to renovate the property, but that is a much more complicated loan that is unnecessary unless you don't have enough equity in your property. So cash out, you get the cash in your hand, or we use the cash to consolidate debt. That means the money never touches your hand. It goes straight from us to the title company, and the title company pays off your car loan and your credit cards directly. Sometimes that's required in order for us to be confident that those debts are going to disappear. Because if you're in a position where your income is tight and we know that you can't afford the new house payment plus your credit cards and your car payment, we're just going to pay off your credit cards and your car payment to make sure that you didn't take that money and go spend it on a world cruise. Okay, so that's the overview of how a cash out refinance works. Now, here's another thing. I was told never to pull cash out of my home. I think that's a great theory, but again, any blanket statement is something that you've got to take with a grain of salt. Your home equity is one of the cheapest places that you can tap into money anywhere because it's tax deductible, and interest rates on mortgages are usually the lowest interest rate loan that you can get. Any other type of a loan is going to come with a higher interest rate, a higher cost, and a shorter repayment term. So bang for the buck, getting cash out of your house is the cheapest place to get money in almost any circumstance. And when you think about a mortgage interest compared to inflation, right now, mortgage interest is paying you. Inflation, the cost of goods going up every single year, is higher than mortgage rates. So technically, there's a formula that says that's a negative mortgage rate because you're paying interest today and spending those dollars and spending less than what those dollars would have eroded in the next year. So a little bit complex theory, but the bottom line is you cannot find cheaper interest than a mortgage. All right, so what are the benefits of pulling cash out? I believe I have a slide about this. Do I, Anna? Yes, I do. Okay, it's cool. So benefits of cash out, you save on your overall monthly payments. Okay, that's one of the things we can do by doing debt consolidation. The other thing is now it's fully tax deductible. Long time ago, the IRS said you can no longer write off the interest on your credit cards. But if you pull cash out on your home, you can write off that interest. And so tax deduction is super valuable. Now there's rules and there's standard deduction versus itemized deductions. But if you already own a home, you're likely itemizing your deductions anyway. Pulling a cash out refinance that has more of your debt going into debt that is tax deductible, that saves you money on your taxes. That is not a reason to do the refinance, but it is one of the benefits. All right, let's go back to that slide and let's see what's next. So we have the ability to pay everything faster. And I'm going to explain to this in a couple of minutes, but the bottom line is one of the benefits is you can take, hey, I pay a little bit to this person, I pay a little bit to that person, I pay a little bit to my car, I pay a little bit to credit cards. You put it all into one debt and it has one low interest rate and you can pay it all faster. So I'll talk more about that to come. All right, so how much cash can I pull out of my home? The truth is you're capped at 80% of the value of your home. And it's not, there's a calculation here that people often misunderstand. You can't get 80% of the remaining equity. Let me give you a simple, let me back up and finish the sentence. You cannot get 80% of the remaining equity. You can borrow a grand total of 80% of the home value. So if your house is worth $500,000 and you owe $400,000, that means you have $100,000 in equity. The difference between what you owe on your loans and what the house is worth, you have $100,000 in equity. People misunderstand and think that means they can borrow 80% of that $100,000 in equity. That is not true. You can borrow 80% of the home value. The home is worth $500,000. 80% of $500,000 is $400,000, and that's exactly what you owe. So in that case, you have zero lendable equity. Think about that. You have zero lendable equity. You still have equity, but you have no lendable equity. Now, that same situation, and let's pretend that you owed $250,000 on your home. Now, house is worth $500,000. I can loan you 80% of the home value, so I can loan you up to $400,000. You owe $250,000. That means you have $150,000 in lendable equity. Now, VA is the only exception to this. VA will let us go to 90 or 100% of the home value. But other than that, conventional and FHA loans cap you at 80% of the loan value. Somebody might say, well, then, John, maybe I should get a home equity line of credit. I'll talk a little bit more about home equity lines of credit and the pros and cons in a minute. But the fact is, a home equity line of credit uses the same calculation. And they say, hey, we will let you borrow up to 80% of the home value. So if home's worth $500 and you owe $250, the most they'll let you borrow is $400, but you owe $250. They'll allow you to get a home equity loan or line of credit for the $150 of lendable equity. So that's how a home equity line of credit and a mortgage determines what is the maximum you can pull out of your home. But remember, the fees for doing the loan have to be included in that lendable equity. All right. Kathy asked me a question. I'll jump in and answer that real quick. What is the longest time I can get a mortgage for? I've seen mortgage companies take 6 months to give you a mortgage. I'm just kidding. I know that wasn't what you're asking. There is such a thing as a 40-year mortgage, but there really isn't. It's a unicorn. The banks are doing that. The government is doing that as a way to help people who are struggling making their payment to modify their loan and stretch it for 40 years. But a new loan, the longest term right now is 30 years for reasonable interest rates. There's some private lenders out there, some private banks that are offering 40-year loans, but the rates are significantly higher. It just isn't worth it, in my opinion. So the longest term on a loan that makes sense is going to be a 30-year loan. All right, so let's go back to where we at next. Rules. Are there rules for how we can use my cash out? First of all, no, you can use the cash out for anything that you want. There are some circumstances in which the cash out isn't considered cash out. And I'll talk about that in a couple of minutes, but you can use it for anything that you want. If you want to pay off debt, great. If you want to use it to pay for a world cruise, great. If you want to use it to help your child put a down payment on a home, great. Lots of things that you can do with it, and it's entirely up to you what you do with that. Now, here's a situation where pulling cash out isn't really cash out. and that's buying out an ex-spouse or really buying out a co-owner. So for example, maybe you bought this home with your sister 10 years ago, and the home value went from, 200,000 to 400,000, and now your sister wants out. Well, guess what? You owe your sister $100,000 because the value appreciated by 200 grand. Half of that belongs to you and half of that belongs to her. So you need to get $100,000 to buy your sister out of the home. How are you going to do that? You need to pull cash out. But the good news is we don't treat it as cash out. I said earlier that Fannie Mae determines the risk on loans, and cash out refinances are a higher risk because there's a propensity once somebody starts pulling cash out that they're going to continue doing that. But Fannie Mae also said, if you're paying off a spouse or a co-owner that currently owns the home, you're kind of buying that portion of the house from them. You're not putting cash in your own hand. You're buying their interest from them, and they're granting that interest back to you. We do it all the time. In that case, you are not limited to 80% of the home value. So if you have a situation where, hey, John, I wanted to pay off my spouse, I wanted to pay off my sister, but you said I could only borrow up to 80% of the value of the home when I'm pulling cash out. We can loan you up to 95% of the value of the home to pay off a co-owner because it's not considered cash out. It doesn't fall under the cash out rules. All right, how does debt consolidation work, and is it a good idea? Well, let's talk about this. First of all, debt consolidation is used for multiple reasons. One of them is to pay off some or all of your debts. Okay, that's really the key. Actually, I should say that's the definition of debt consolidation: paying off some or all of your other debts, credit cards, car payments, etc. What you need to focus on is something called the blended rates. The blended rate is the average interest rate based on how much you owe on that debt. So let me say this again a little more clearly. When you look at a blended interest rate, you might say, hey, John, I owe $100,000 on my mortgage, and it is at a 4% interest rate. Awesome. But you also have a home equity line of credit that has an 8% interest rate, and you owe $100,000 on that too. That means that your average interest rate isn't 4% or 8, it's 6. Now, if you only owed $50,000 on that 8% home equity line of credit and $100,000 on your first mortgage, then your average interest rate is 5 because you have double the amount of money at the low 4% rate and only half of the amount of money at the 8% rate. So your blended rate is not the dead center between those interest rates. Blended rate is really what I focus on when I'm in a position like we are today. Most of you have a lower mortgage rate than where market rates are today. But if you have a reasonable amount of debt, credit card debt, car payments, home equity loans, and lines of credit, there is a good chance your blended interest rate is far above today's market rates, and we can refinance you to lower the overall cost of your interest and make it all tax deductible. So that's how blended rate works. Now let's talk about let's go back here. Here we go. Yep. So focus on your freedom point also, because the freedom point is, when am I done paying off my debts? People think too much about, oh man, I don't want to take my 7-year car payment and pay it over 30 years because I don't want to owe my car for 30 years. But the fact is, if you take what you were paying on your car and you're paying on your house and you put it together, you might pay everything off in 17 years and you're debt-free in 17 years. Otherwise, you're going to be in a position in 7 years, yeah, you paid off your car, but you still have 23 years left on your mortgage. So think about your freedom points. When are you planning on retiring? If you're 30 years old, I wouldn't be worried about paying off my debt anytime soon. I would be looking at what are my short-term needs, not wants. What are my short-term needs, and how do I best manage my debt long-term to build wealth through real estate? And sometimes debt consolidation, sometimes cash out to buy another property is a great way to leverage time on your side instead of saying, how do I pay it off faster? But freedom point is something super important to think about. Okay, let's go back to that slide now and take a look at what's next. It lowers your debt to income ratio for other purchases. You might be in a position where you're trying to buy another property and you have some credit card debt, you have some car payments, and I look at it and say, man, your debt to income ratio is just too high to make this work, because when you add that vacation home, your overall bills are just too high. So maybe we look at a debt consolidation loan that allows us to lower the overall amount of payments. You can still pay extra. You might say, John, I can afford to pay that extra amount. Well, on paper, it doesn't show that you can. So by consolidating debt and stretching it out for a longer period of time, we open up your options to take out other loans that will help you grow your net worth over time. This is all about strategy. Very few mortgage people think about strategy. They think about, can I lower your interest rate? Can I lower your monthly payment? And they aren't thinking big picture. That's where I come in to serve you, because I'm thinking big picture and I'm thinking strategically, asking you questions about what are your goals? How long are you planning on keeping this home? Are your kids going to college anytime soon? What's your plan to pay for college? What's your retirement plan? How soon are you retiring? And how long are you planning on keeping this home? All of those things come into play. All of those things come into play to say, is this a good idea or not? And only one of them has to do with, is my interest rate lower? So there's lots of things. I think I have one more bullet point on that slide that I want to go over. And that is, you can combine properties together for more leverage. So let me explain to you how that works. You are in a position right now where you might own 7 properties. And you say, I want to buy more properties. And you come to me and say, hey, John, can you help me buy more real estate? I want to acquire more properties. And I say, yeah, no problem. Except there's a cap at 10. Once you have 10 properties with loans on them, I'm done with conventional financing. I cannot do loans through Fannie Mae and Freddie Mac. Your interest rates, your down payment requirements, your reserve requirements are going to skyrocket because I cannot use the best source of money, which is federal government debt through Fannie Mae and Freddie Mac. But there's an alternative where we can combine mortgages together. Depending upon how long you've owned your investment properties, you might be in a position where you've got enough equity in one home to be able to combine the debt from the 2 homes together into one. If you're trying to build a portfolio of real estate, this is a great strategy to get past the 10 property cap, because as you grow equity in those properties, you've got the ability to combine 2 mortgages into one. It's not a rule that says, how many properties do I own? You're not limited to owning 10 properties. You're limited to having 10 financed properties. So if you combine debts from 2 properties into one, you now have fewer financed properties. All right, let's go back and talk about debt consolidation and kind of how it works. So let's dig a little bit deeper into my slides and talk about what that's going to look like. Let me pull that up here. Okay, so let me give you an example of debt consolidation. What we're looking at here, this is someone that has a current mortgage at 4.5% interest, 25 years left. Same example I used before. They have a car loan that they just took out. The credit's not so great, it's okay, but they got a 7-year car loan at 9% because interest rates are skyrocketing. And guys, I don't think that's far away from 9% car loans. They've got $30,000 in credit card debt at a 24% interest rate. That is not unheard of. And interest rates, if your credit cards are lower than that, that's great. They're going that direction. We're going to see around a 3% increase in credit card rates this year. So if you're at 17, you're going to be at 20 by the end of the year. And then they also have a $75,000 home equity line of credit at a 5.5% interest rate, because your home equity line of credit rates have also been skyrocketing due to the Federal Reserve raising rates. So that person's blended interest rate is 6.4% when we average all of that together. So now let's use this example and say we refinance you at 5.75. Well, the first thing you're typically going to say is, oh my gosh, John, 5.75, I'm at 4.5. Why in the world would I want to refinance my 4.5 to 5.75? Well, remember what I just showed you in the slide before, your average blended rate, not average, but weighted blended rate is 6.4. I am dropping your interest rate from 6.4 to 5.75. I'm also giving you tax deductibility on all of that debt, and I'm saving you $819 a month by consolidating that together and getting rid of the payments you had on the credit cards, the car loan, and the home equity loan or line of credit. But here's another option. Let's make this one a little bit bigger. So in this case, you can say, you know what? I don't need to save the $819 a month, John. I'm just going to keep paying what I'm paying today and I'll be fine. Well, here's where if you just consolidate those debts together, even though you're raising your rate from 4.5 to 5.75, you actually continue making your current mortgage payment. You are debt-free. Your freedom point is 17 and a half years. You're debt-free. Instead of 25 years to pay off your mortgage, you're debt-free in 17 and a half years. If you're in a position where you're like, hey, I'm 49 years old and I want to retire in my early 60s, this is how you do it. But you got to be talking to me regularly, getting a strategy about, hey, this is where I'm at in my life, and this is where I want to go next. The other thing is you can invest the savings. I should have made this one a little bit bigger. I apologize, I didn't. But the bottom line is, here's what this example is. Let me get rid of that for a second. So here's what I advise for the people that are willing to take some risk, and that return comes when you are able to invest the money that you are saving every single month into the stock market. Now, I'll show you in a couple minutes how this is going to work, but let's just dive back into the numbers here. What we're looking at is, oops, my bad. All right, so you're actually, if you invested the money into the stock market, in 14 and a half years, you'll have enough money invested. I'm talking about investing your savings. So we take that $863 that you were saving by consolidating your debt. You could have added that to your mortgage payment and paid off in 17 and a half years. But instead, if you invested in the stock market, over time, the average gains is about 10% per year in the S&P 500. And I'll show you a chart in a minute that explains that or validates that. That means that you would have enough money in 14 and a half years to write a check to pay off the mortgage. So you're paying off even 3 years faster, but more importantly, you have that money sitting there on the side that you can use if necessary and never have to refinance to pull cash out again. All right, so when is it a bad idea to refinance? Let's actually, I apologize. I shouldn't have gone to that part. Anna, catch me up. Where are we supposed to be at? Anna's helping me run all of this stuff. All right, so should I do a home equity line of credit instead of a cash out refinance? Maybe. First of all, home equity lines of credit have lower interest, lower upfront cost. You're not going to write a huge check to pay $7,000 or $8,000 in fees to get a home equity line of credit. So if you're thinking, hey, John, these ideas make sense, but I'm not sure that I want to refinance my mortgage. If you have a great first mortgage and you only need a small percentage, in other words, if you owe $500,000 at 2.5% and you need $50,000, go get a home equity line of credit. There is no point in taking $500,000 from 2.5 and making it $550,000 at 5.5. Go get a home equity line of credit. Who cares if the home equity line of credit goes to 8%? You're still way cheaper in blended rate by having that small amount of debt compared to the big mortgage you have at a lower interest rate. So it's about blended rate. And I tell people all the time, do not refinance, go get a home equity line of credit or home equity loan. I actually have a video that'll be posted down below in the description of this. That is my video on should I do a cash out refinance or should I do a home equity line of credit? And it's about a 5 or 6 minute video going into more detail. All right, so let's talk about when is it a bad idea to refinance? I believe I do. All right, so bad idea to refinance is if you plan to sell or refinance again soon. Now, if you know you're selling in the next 2 or 3 years, probably not a good idea to refinance. You're not going to recoup your cost. Now, sometimes it actually is necessary. Let me tell you a quick story here. I have a client who I am working with right now that has low credit. They have a lot of collections. They have a lot of judgments. They're behind on their bills, but their credit's good enough to do a refinance right now that will allow them to fix their credit problem. Their credit scores are bleeding. They're dropping on a regular basis because they're behind. So and they don't qualify for a home equity loan or line of credit because their credit score is low. So a refinance allows me to give them the cash out they need to stop the bleeding and to be in a position to buy a home a year from now. If they didn't pull cash out, they're going to be in a position where their credit scores continue to deteriorate, and a year from now, they won't be able to buy the home that they want to buy. So even in situations where you know you're selling the home, there might be a circumstance where it makes sense to do the refinance. All right, don't refinance just to get rid of PMI. If you have an FHA loan, you have to refinance to get rid of PMI, but that still does not make it worthwhile, because if you have an FHA loan at 2.5, your PMI might be 0.8%. That means that your effective rate is 3.3. Why in the world would you get rid of a 2.5% FHA loan with 0.8% mortgage insurance for an effective rate of 3.3 when rates are at 5 or 5.5? That baffles my mind, but people are so convinced that mortgage insurance is bad that I need to refinance to get rid of it at all costs. That is not a smart way of thinking about it. So do not refinance simply to get rid of mortgage insurance. and conventional loans let you get rid of mortgage insurance without refinancing. So don't refinance to get rid of mortgage insurance on a conventional loan unless you can get a lower interest rate to give you a lower payment, all the reasons I talked about earlier. But just getting rid of the mortgage insurance is not a good reason to refinance. And then don't refinance to lower your payment after paying down your balance. The fact is that you can pay down your balance and do what's called a principal reduction modification. A principal reduction modification comes into play if you just got an inheritance or won a small lottery and you owe $400,000 on your mortgage and you want to pay down half of it. You want to pay down $200,000. Now you can do that and write a check on the mortgage. The problem is you're not going to get any lower of a monthly payment. And so in this case, what you can do is you can write a check to pay down the balance to 200, call the bank and say, I want you to re-amortize my loan over the remaining term based on my lower balance. You get to keep your current interest rate. The fees are $500 to $1,000. They're not that expensive for them to rewrite the term, rewrite the paperwork, and you don't have to give up your current interest rate. So never refinance simply to do to pay down the loan. Never refinance to get a lower monthly payment if you have a good interest rate still. So speaking of that, let's talk about what is a cash-in refinance. So a cash-in refinance, there are times when, hey, John, I can lower my interest rate and I can have a lower balance. So you're going to bring cash in. So if you have a large chunk of money that you are trying to bring in, then you are going to be choosing between, do I want to pay that cash into the loan and refinance at the same time, or do I want to use just the principal reduction modification? All right, I've got about 2 minutes left. I want to quickly, and I think we missed the slides on debt consolidation and talking about the S&P 500. Can you go back to that slide there? Because there's a couple of slides I've got that are talking about she's going to pull those up. As soon as you get those up, guys, if you have any questions, I've got about 12 of you watching right now, or if you're watching recorded, please go ahead and I think there was a chart with the S&P 500. Did we miss that one? Maybe we did. Anyway, let me explain to you guys the theory. The theory, go ahead and get rid of that, Anna. If you have any questions about anything we've talked about, please let me know. Post it in comments right now. If you're watching live, I'll answer it. If you're watching recorded, I'll come back afterwards. Guys, here's what's happening. And I'm giving you a quick lesson in economics over time. The fact is, the stock market is a great long-term investment. Over time, the stock market has returned over the last 30 years an average of 10% per year. That's actually up through 2020. The chart that I had pulled up came up through 2020. As a matter of fact, it looks like, okay, here we go. So when we're talking about, should I always go for the shortest term? That's where I missed this. So what you're looking at right now, let's make that really big, Anna. This is the S&P 500, and this is going back to 2013. You've seen some dips, but over a 9-year period, the stock's prices went up significantly. Now we're experiencing another dip right now, but we had a huge dip in 2020. And when that huge dip happened in 2020, you see it rebounded within 6 months. So if you bought on the dip, no matter if you were even halfway down the dip, even if even if the stock market had fallen only partially and you got part way down that dip and they kept falling after that, you still were way better off at the beginning of 2022 than you were if you had not bought at all. The reason I bring this up is simple. You are in a position when you think about refinancing to say, do I put more cash to pay down my mortgage? A lot of people actually think about, should I pay off my mortgage faster? And what I'm telling you is if you're willing to take a reasonable risk, your mortgage is tax deductible and the interest is stable and fixed. You have the ability to take the savings you get from refinancing, and even if you stretch out to a whole 30-year term, you take that monthly payment savings and you put it into investments in the S&P 500, in the stock market. Pick a mutual fund. I'm not telling you what to invest it in. But the fact is, you get the benefit of what's called dollar cost averaging. You didn't throw a whole bunch of money in there one day. You're buying a little bit over time. As it falls, you get it on sale. As it goes up, you get the benefit. Over time, we saw those values of stocks go up significantly. So you take your $800 a month that you would have put extra on your mortgage, and instead you invest it into the stock market. That money grows over time. Yes, there's volatility, but as you look at that chart that I was showing you, and I'm going to pull that chart up again right now, you are absolutely going to be in better shape. Historically, prior performance does not guarantee future results, but you're in better shape taking a lower mortgage payment and investing that money. That also includes if you're thinking about buying a home and you're saying, hey, should I put the biggest down payment possible? The truth is, if you put a small down payment and you invest the chunk of money you were going to use, now you have a backup, you have a cushion, you have a reserve to keep you from needing to ever pull cash out again. I know I covered a whole lot in the last hour. I apologize for starting a minute late. Next Friday, I'm going to talk about retirement planning, Social Security, what things. I'm going to have some experts in here, so you won't be listening to me for the whole hour. But join me next Friday at noon. We're going to talk about Medicare, lots of things you need to think about. And guess what? You are never too young to start thinking about these things. If you're in your 20s and 30s, your parents are thinking about that. You need to know these things so that you can help them make good decisions. Should you take Social Security early, on time, or late? Lots of things we're going to talk about, how to protect your assets in case of Medicare and needs to have care. A lot of things we're going to cover. I'm looking forward to continue being a resource for you. Holler if there's anything I can do, and have an absolutely amazing weekend.